Okay, guys, we're gonna get started because it's 11:03. Thanks for being on time. You guys are awesome. I gotta share my screen. Linda Tuttle, we met Linda through Shayna Clark. A lot of you guys know Shayna, and they met through a different business, and now they're working together on taxes and stuff. And we were just saying how this isn't really an exciting topic for a lot of people, but so important. I always say, because I heard it long time ago, it's not so much, it's not as important how much you make as how much you keep. So taxes are an important topic, and we are also talking about tax advantages and rules and stuff that we are aware of that we don't always take, especially if we're doing our own things, right? Doing our own books or whatever. So having a professional that can maybe help take advantage and make sure you're actually implementing tax strategies is going to be pretty awesome. So Linda, come on up. While I share my screen, just introduce yourself. This is Linda. You guys here have all met her in person, and tell us a little bit more about you, and then I'll give you the clicker and you can rip into it. Okay, cool.
I am Linda Tuttle. I have been a CPA for 22 years.
Wow.
A lot of years of doing the fun stuff, but married to Andrew, and who is a real estate agent, but I get this industry, and I'll be honest, you kind of stay in your own little bubble for a long time. Okay. And frankly, I got a little bit burned out a number of years ago. I was like, I'm tired of doing this. But I realized I was doing what I was taught in school and not expanding my knowledge. And I've learned there's so much more to know about taxes that you can learn outside of school. And so I've really invested my time and money the last couple of years, just really advancing my skills so I can turn around and help other people and really be that advisor. So that's a little bit. I had a slide that'll show you here in just a minute, but excuse me, I've got something. But maybe. Thank you. Okay, so as I go through this today, the first thing I like to know, I had a few minutes to talk to most of you ahead of time, and I know there's some online who want to try to talk to you as well. Tell me, how long have you been in real estate?
You're looking at me, so
Yeah.
20 years.
20 years, so you've
Yeah.
got some history too.
Probably two.
Okay,
No history.
no history. No, yes, that's a history. And actually, are you actually?
I'm
licensed?
licensed. I've been licensed for a couple of years, but I grew up with these people.
But you got
You've been- Been surrounded, and you must be Lynn. How about you?
I'm coming up with my license on 3 years.
Nice. Okay,
Have some rental properties as well.
great. And you guys,
I've been almost 7. And
Almost two.
okay, and you said since 09, is that right?
I got licensed in 09, yeah.
You've been involved.
And then Lynn got hers in 14.
Nice. So some of this honestly might be a little bit basic. I don't know about people that are online, because I when I first shared this, I realized I want to start, okay, here's some basics of what it means to be self-employed, and then kind of move into more of the strategy. So hoping wherever you're at that you can pull out a nugget that'll be helpful to you. I know you're good with numbers, I've been told, but who else here is like, I hate numbers? Okay, got a couple of them. Do you like digging into the numbers? Anybody?
No.
Yes.
Yeah.
Okay. No, it's interesting to talk to people, because some people are like, I don't even want to look at it, just do it. Other people are like, oh, I love to learn this.
I'm
So
like in the middle.
kind of in the middle.
Yeah.
Okay. Well, I'm a numbers nerd. Love spreadsheets, but no, I'm Linda. I kind of branded myself as the adventuring accountant because I like to think I'm not the typical accountant. I love to be outside. Don't sometimes get there as often as I should, but
Not
love to be
boring.
in nature. I'm not boring. So I'm not boring to you. This is our family. We have 4 kids, and 3 of them, it's kind of hard to tell in that picture how old they are, but 3 are young adults from ages 19 to 22, and then we've got a 15-year-old that's still in high school. This was the summer in Alaska. We were able to go do that as a family, and I'd like to share that just because I feel like we kind of embraced the work from home, be self-employed lifestyle, well, pretty much our whole marriage. Not a good combination always to have commission income and CTA wife. But we figured out how to make it work, and I don't know, I love sharing this because I just truly love to help people build business and find things that they love. So that's a little bit about me. Okay, want to start just kind of telling a story, and maybe this can relate to some of you, maybe hopefully it doesn't, but I had a friend come to my door, this was probably about 10-15 years ago, and he had gotten a real estate license that year, but didn't know anything about it, and it was like April, and he comes to me, he's like, Linda, I'm trying to file my taxes, and it says I owe $10,000, and I don't have that, what am I supposed to do? And he was just in this panic because he didn't even know that he was gonna have these taxes due, and he didn't know what his deductions were, and he was just stressed and overwhelmed. And I tend to take that on, you know, when my clients are feeling that way, I think, okay, let's fix it, but there's only so much you can do in April after the fact, right? Versus, one of our kids, our oldest daughter, actually got licensed in 2020, in the middle of the pandemic. She had plans change on her, and she ended up home, and what else am I gonna do? Oh, I'll go get my real estate license. Happened to be when he was selling for a builder, and she was able to sit and model and have money come in pretty easily. It was a pretty good setup, but she had me and she just set her money aside. She knew how to keep track of things, like she had her spreadsheets, we filed her taxes. It wasn't a stress. And so I share that just as a comparison, because I hope that you can be the latter, find an advisor to really help you. If you don't love numbers, to be able to just take some of that stress away. I've had, just this last month, I've had so many come to me, like in December, they're like, I created an S corporation, I didn't do any payroll, I don't know what to do. And so we're like scrambling to get everything set up. So this is, like I said, starting from the beginning, but hopefully that's something that will help you. I would have to just do my disclaimer as I'm sharing this information. I'm, you know, presenting this for education purposes. I'd be happy to engage you as a client, but this today does not establish any client relationship. But okay, I'm guessing you already know this. Did you know that taxes are one of the most expensive things in life? One of your biggest expenses you're going to incur. Raise hands. Do you think there's something that you can do about it?
Yes.
Okay, a lot of people that I talk to are like, well, it is what it is, I just have to pay my taxes. And I'm here to say, no, there is something that you can do. You can be proactive. You are the business owner. By being a real estate licensed agent, you are a business owner, and you do have control over this.
Question for you.
Yes,
Just being real estate, having the license means I have my own business, or do I need to go set up a business license?
you well, you are a business owner, and the way you're gonna file for taxes, you are a business owner. I'm not 100% sure on the business license with
I've
your.
got a business set up, but just for the sake for like anybody, like I got my license, I don't have to go set anything up. I can just claim that I have. I am.
Yeah, then we'll go through some of this, like there's different levels of it, and depending on where you're at with your business, what your
Yeah,
best
you're a
situation
business
is.
owner if you're self-employed,
Yeah.
that would be a sole proprietorship. If
Yeah.
it's just you on your own, entity structure is something, you know, different, but yes, you do business by yourself,
Yeah,
you have a
so you,
business.
yes, consider yourself a business owner, and everything I'm talking about today, it's your role as a business owner to maximize your deductions and keep as much as you can. That's what I'm here to show. So, and we'll go over the entity type a little bit. Okay, so this is what I am hoping to have you come away with, is uncovering some of the secrets to maximize your hard-earned money. You work hard for it, right? You were just discussing no easy transactions. Sometimes there are, we've had a few, but not usually. Usually you very much earn that commission that you get by the time you're done, right? So you want to keep that as much as you can and not be spending it all on taxes. And I hope by the end of this, you'll have a few ideas to help you transform your financial outlook and keep more money in your pocket. Sound good? Okay. You're on the right place because you're agents, you've told me that, and hopefully looking for ways to safe. We were discussing rental properties, and a lot of times I run into people who heard there's some tax benefits to owning real estate, but they really don't know what they are. Or you just need to know, like, what should I be asking my tax advisor? So, welcome, welcome. I have quite a few topics, and actually, that we're going to cover, so here's just a high-level overview, and then we'll dig into each one a little bit deeper, but like I said, we'll start basic with what does it mean to be self-employed versus a W-2 employee, type of entity structure, converting personal expenses to business expenses, how to maximize your auto deductions, paying family members. One of my favorites is the health savings account, maximizing your retirement contributions, real estate and taxes. I'll get a little bit into cost segregation and short-term rental loopholes, so you can be aware for clients. So that's what we're going to talk about. Like I said, if this is new to, if you're new to real estate, this is important. If you've been here for a while, maybe you can help explain it to somebody else. Can you see that, or is that too small? Kind of played with these slides and I was trying to figure out, but hopefully you can see it. So as a W-2 employee, somebody else is taking out the taxes for you. I'm sure you remember, or maybe anybody still have a W-2 job, or is everybody solely commission? Okay. So Social Security, Medicare, federal withholding, state withholding, your employer is taking all of that out of your paycheck. Kind of, I call it the forced savings. You don't really, I mean, you can claim what exemptions you want, but you can't decide whether you're paying it or not. It's kind of forced. Taxes are withheld equally throughout the year, and so small I can't even see it myself. The very few deductions. In my opinion, the tax code's this big, and it's really, there's kind of like two different ways of looking at it. You've got your W-2 employees have this many options. As soon as you're a business owner, sole proprietor, entity or not, it opens up the tax code to you and allows you to take a lot more deductions. But the thing when people are first getting started with real estate that they don't realize, or starting any other type of business, is that you are now responsible for your taxes. Nobody's going to be withholding those for you. There's no forced savings, so you have to make yourself set a portion of that aside. And the government likes their money, so they like it paid equally in 4 estimated tax payments. There's a lot of things that go into that. Depends on your other income, depends on how much you can write off. It's a lot of factors, but those are some quick comparisons on being a W-2 employee versus a 1099 contractor. Okay, this is one I like to dig into a little bit, just kind of go over pros and cons on the different types of entities. There's a lot of information out there online, and you get promoters that want to sell you an LLC, or they'll tell you you have to be an S corporation. And I'm here to say there's not a one size fits all. Everybody's business is different, everybody's situation is different, and so I would recommend talking to your tax advisor or your attorney to get your structure set up the right way. But I will tell you this, no matter if you're a sole proprietor, an LLC, an S corporation, this is kind of I tell everybody this, like, have a separate bank account. I can't tell you how many times I have clients come to me and they've got, oh, well, I paid for this here, and it's like, smiling, but it happens all the time. And the biggest thing to me is that you're gonna miss deductions. If you are paying for things on a personal card and then it comes tax time, you're going to miss things. The other reason is if you've got it set up that way, you're telling the IRS, yeah, I'm treating this like a business, and they're gonna look at it like you're really running a business, and it's just gonna make your life easier when it comes tax time. You'll be more prepared for an audit. So no matter what, treat your business like a business. You want to keep receipts. I know it's a big nuisance. It used to be that you could just have like your credit card statement, but there's a lot of software out there now that makes it so it is much easier to actually keep backup of your receipts. You don't have to have a shoebox of them. You can keep it all electronically. Okay, as far as entity, so sole proprietor, that means you became an agent, you get a 1099 from the brokerage, you're a business owner. That's going to be filed on Schedule C. The pros of that is it's easy. It's on your individual tax return. There's not an extra tax return that has to be filed. Anybody can, I mean, you can go drive Uber, you can do any of those things. You're still independent contractor with Schedule C, so easy. The con to it is you have self-employment tax on the full amount of your net income. The other con is that there's no legal separation, so when it comes to being sued, anything like that, you are the same as your business. So easy to set up. Those are the cons. LLC, doing something like real estate, yeah, there's some liability. Anytime that you've got potential liability is when you want to look at LLC, which is limited liability company. And people come to me all the time and say, hey, I started my business, I got my LLC all set up, I'm all ready for taxes. And I'm like, great. Doesn't make any difference at all when it comes to taxes to be an LLC, unless you elect to be treated as an S corporation. So sole proprietor and LLC, you're subject to what's called, I skipped that on that last slide, it was up there, but the self-employment tax, which is 15.3% of Social Security and Medicare. That's before federal or state income tax, so it can add up pretty quickly. And so once you get to a certain threshold, and this is where I say I find people creating an S corporation before it's time. An S corporation allows you to treat part of what you're paid as a salary and part of it as distribution. So it allows you to reduce that self-employment tax. There are extra compliance reports that go with that. You've got to file an extra return for the S corporation. You have to file quarterly payroll tax returns. Worth the headache if you're making, I mean, again, depends on your situation, but I'd say roughly 40, 50,000 is your net income, then it makes sense to do the S corporation. There are some arguments that you can do it less, because if you're going to have a loss, like it's your first year, it's easier to claim a loss on an S corporation, less chance of being audited on an S corporation than it is the sole proprietor. Again, there's no one size fits all. I personally love LLC taxes and S corporation, but talk to your tax advisor and attorney to figure out what's best for you. Okay, this is one of the things I get most excited to talk to you about, because as a business owner, like I said, that tax code opens up to you and allows you to convert what would otherwise be personal expenses and convert them to tax deductible business expenses. So these are some of my things. You can tell you, I love to travel. So if you can take travel and find a way to make it tax deductible business purpose, like there are ways to do this. I could do a whole extra talk just on the travel side of things and how to bookmark it so that the whole trip becomes tax deductible. But find a way, like if you're going on a family trip, find a way to have a business purpose as part of it so that it can become deductible. Most people have some sort of home, some sort of space that, you know, you're operating your business out of. Having this business now allows you to take that home office deduction. Your car, you're likely driving a car whether you have a business or not. If you're a W-2 employee, no benefit for driving that car unless you've got an employer that reimburses, you know. But as far as tax deductions go, eating out, your cell phone, computers, cameras, office supplies, all these things that potentially you would have, business or no business, now become deductible. This kind of small too. I kept trying to make it fit better, but this is just a real simple example of how this works and easy numbers for simplicity. But let's say you make $10,000, and I think these are all very reasonable numbers for these deductions. You know, your cell phone. There's some rules on this, like you are going to deduct the business use percentage. So just because you have a business doesn't automatically mean that 100% of all of those expenses are deductible. But if you have another phone that is available to the household, you can actually take 100% of the cell phone. Auto, this one, especially for real estate agents, is a huge benefit. Excuse me. This year, the IRS bumped the standard mileage rate up to 67 cents per mile. That adds up in a hurry if you're really keeping track of your mileage, and I'll talk about auto here separately in a little bit, but. So let's say that's 4,000, meals, $1,000, travel, 2,000, conferences, 500, your licenses and dues, so. You've got all those expenses. And in this example, they totally wipe out your income so that your net income that you're paying taxes on is zero. So that's how that conversion to the business expenses works. On the flip side, again, these are easy numbers, but 20,000, and you still have those 10,000 expenses, you're still taxed on 10,000, rather than if you picked up an extra W-2 job and are made an extra 20,000, you'd be taxed on that full 20,000. So as you grow, there's more strategies, you can get your numbers significantly higher than this and what you're able to do that. But just, again, hopefully that lets you see the benefit of having some of these deductions. Okay, when it comes to auto, there are two different ways that you can write off your auto expenses. There's the actual and the standard mileage rate. Actual means that you're really keeping track of gas, oil changes, repairs and maintenance, all the things that you're actually paying for. You do need, where I say here, kind of know your style. If you're not one that's going to keep records, may or may not be the best method for you. But it depends on the vehicle, depends how much the vehicle costs, depends on how many miles you're driving. One thing to keep note of is that you can't flip-flop back and forth. So if you get a car and the first year you take the standard mileage rate, you can't the next year say, oh, now I'm going to do the actual method. You want to stick with that method for that vehicle. Now you could have a car and you could have a car and do the actual method on one and the standard on the other, but you're going to want to stick with that same method. Now,
just between vehicles, right? So if I've been doing the standard, I get another vehicle, then I can do the more in-depth one on that vehicle.
Yep. And there's some really good rules to, I'm gonna get into it actually on the next slide, but a lot of times it does make more sense to do the actual. One thing to keep in note, if you have a loan on the vehicle and you have interest that you're paying, you can take that either method. If you're using the standard or the actual, you can take your interest for the business use percentage. My note there, real estate agent, it's probably hard to say, yeah, it's 100% business use, 90%, probably. I think I do the bulk of his, because you're always driving, you're always looking at property, you're always, there is more argument for you as real estate agents to have that be a much higher percentage.
You see real estate
Everywhere you go, yep.
Every window we look out.
Yeah.
There it is.
So, yeah, much higher likelihood of taking a higher percentage. Okay, so these are the 7 auto rules of thumb that you can kind of tell, okay, when does it make sense to take the standard mileage rate versus the actual. If you're driving a lot of miles on the car and it's a lower priced vehicle, your mileage is almost always gonna come out ahead. If you've got low mileage and kind of the average price of your vehicle, one other note, you can't use the actual method unless it is at least 50% for business use. Like I say, in your case, you probably all can justify that it's more than 50%, but that rule is there. If you have some type of vehicle that you really aren't going to be driving very much, so you have low mileage, but it's a higher purchase price, then you probably want to take the actual. The benefit that I didn't mention with the actual is depreciation, which basically means you're writing off the value of that asset over time. There's some new tax laws, you've got what's called Section 179 and bonus depreciation that allow you to take off the bulk of that vehicle in the current year. I know he's been happy a year or two. I've said, you gotta go buy a car. He's like, dang it, I have to go get a new truck, but, yeah, there are tax benefits.
Is there any depreciation recapture like in real estate?
There is, yes, so if you go to sell it, then again, you've got to talk to your tax advisor. It's not always like every year you want to be doing that, because if you go to sell it, yes, there is some recapture.
Because you would have to recapture all the saved benefit of the deductions, right? You'd have to repay on those taxes.
So there's,
I mean, the idea would be is you wanna go through that 2 or 3 or 4 or 5 years you depreciated that vehicle out.
so there's some advantage to that, you know, some tax advisors are like, oh, write it all off, but sometimes it is nice to write it over that period of years, 5 years, so you are getting some benefit over a period of years rather than all in 1 year. And again, it really just kind of depends on,
your other deductibles, right?
yeah, the situation. Does it make sense this year to take the full amount, or does it make sense to spread it over time?
I heard that they passed a law, you know, when I did my last one, it was 2 years ago, it was 100% of my $80,000 truck. And it saved me like $30,000 or $40,000 in taxes. Either pay $30,000 or $40,000 or buy a truck.
Right.
And so I took it all off, right? But I noticed that they've changed the law for 2022, 2020.
So that's the
Like it's
bonus
reduced.
the bonus depreciation
Yeah.
was 100%
Yeah.
in 2020.
Now it's down to 60%.
Yeah, this year for.
But I heard that the Congress has actually just passed it to go reset it back to 100,
They,
retroactive.
did
Which-
it actually pass? Cause
I don't know, but
a
that
day or
could be-
two ago, I know it was in negotiation, but they hadn't actually passed it. They like to keep us on our toes, and you know, it's already tax time and, hey, let's change all the laws, so.
Wait, so. Hey, could you just recap that whole thing? So, because I hear, I could, instead of paying taxes, still buy a new.
You wanna know about the bonus deduction
It
for.
depends on the car too.
Yeah,
Okay.
so let me do a caveat that I'm not going to tell you, go buy a car just to save taxes. If you don't need a car and it's gonna put you in a bad situation because now you've got
But the
a
rule
loan
says-
on the car. So be smart about it, but yes, potentially it can be a huge deduction, so. Let's say you buy a $50,000 vehicle. If, and this gets down here too, there's weight limits, if it's over 6,000 pounds. Then it's eligible for what's called section 179, even before bonus depreciation was a thing. The bonus depreciation has, again, that's what allows you to write off the value of the car over time. With that bonus depreciation, it's saying, hey, you can take all of that portion in the first year. So it allows you, it's not paying your taxes, but if you bought a $50,000 vehicle and we get back to that 100% bonus depreciation. Again, with the rules, depending on the type of vehicle, you could potentially reduce your income by 50,000. It's not going to be a dollar for dollar tax savings. That
So
makes
if
sense.
so it comes back like, hey, I owe 40,000 in taxes, it'd be worth asking my CPA, like, hey, would it make sense for me to go?
It's always worth having that conversation.
The car I need to replace to the.
Now, it's hard to say that in January right now, like a lot of times if it comes to December, that's when we've ended up purchasing them. Oh, I kind of done a projection and said, hey, we need some extra write-offs, so.
And if-
And nice new cars in January.
Mhm.
Yeah, if any time in the fourth quarter, your CPA says, hey, you probably need to go buy a new truck for tax purposes. You run, don't walk to the dealership and get it done.
Anyway, talk to your tax advisor is the short of it. I bring these things up so you can be aware. Again, you have options, so you know what to ask, because there are a lot of tax preparers out there, and I will say I'm guilty of it for a lot of years of just filing whatever my clients gave me instead of, I shouldn't say that. I've always been more proactive on, okay, what about this? What about this? But like I said, I've leveled up my skills, and not every CPA is invested. Like there's a lot out there that is not taught in school. I will say that. So ask these questions, and if they say no, or I don't know, I mean, I always say if there's something I don't know, I'll go learn, but just be aware.
It's just like in real estate, I mean, you need a strategist that's gonna help you, keep your books and do things a certain way during the year so that you can take the biggest advantage. When we're talking to people, it's like we're giving them all their options so that they know why they're doing what they're doing, right? So you don't wanna find out in January or February or March, it's like, oh, what, you're saying if I would have done this, then I would have saved 20 grand or whatever.
It's like telling a client, hey, you should have done a 1031 after it's sold.
Yeah, after you've already closed.
Exactly.
Yeah, it's like, oh yeah, you could have deferred all those taxes. It's like,
Yes, so much.
no referrals coming from that dude.
So, and I can't, in
It's
this
like until-
setting, go over every scenario, but I bring it up to just let you know that, yeah, you have options and there's things to discuss. Did you know about paying family members? Nod, yes, if anybody here have, like, I know Clark's children under 18.
A lot of them.
A lot of them. And I don't know about any of you online, but, there's no write-off if you're giving your kids money to pay for their things. But if you can find ways to employ them through your business, have the business pay them, and then your child turns around and pays for their sporting things, that is a win-win, because it reduces your income. With children, this year, the standard deduction is up to 14,600.
2,000 raise, isn't it?
It was
Was it
12,
12?
it was 13.
Oh, it was 13?
Something last year.
Maybe that was the year before.
Yeah, but they keep bumping it up for inflation, which is good. There's rules around this too, like you need to keep records. You have an S corporation, you can't pay the child directly out of the corporation because an S corporation can't have children, but there are workarounds for it. The nice thing is that children are not subject to Social Security, Medicare, that's that FICA withholding. Like I said, they can earn up to that 14,600 and they have no taxable income, but you've been able to shift that much of yours. If they are over 18, you can still pay them. If they are actively, part of your business, you give them a W-2 or you can give them a 1099. I need to employ this more often than I do. When my kids were really little, I would have them help me unpack orders and help me do this, and they thought it was great. And I'd have them keep up. I'm such a spreadsheet nerd, but they'd have to write in their hours that they worked, and I'd turn around and pay them.
My kids are paper shredding experts.
Yes, mine just got paid for that. He only halfway did the job. I had to finish it.
It's huge.
It is a lot.
They can pay the cost of. They can buy groceries.
So that's why, age appropriate. I'm not gonna say go pay your 2-year-olds $14,000 for being cute. You have to have them actually doing something
Unless
for the
you're-
business. And you can have them on your marketing.
Your
On your website, look at all my grandkids.
Yeah, that was a question. Grandkids don't fall into that, right?
You can actually pay your child and then have your child, like you're not gonna get the same deduction to directly pay the grandchild, but there are workarounds to make it possible. Yeah,
The children are under 18.
but it's gonna be a wash for them. So they would basically show it as income, but then they're gonna turn around and pay it to their child, so it zeroes out on their tax return.
Becomes an expense for them.
So the benefit here is really for under 18.
That's the
Under 18,
biggest benefit, because
You're
you're,
benefiting from not having, they're not paying social security and FICA, and then you're getting a
you're
deduction.
shifting that much of it, your income. So yes, there's rules around it, but this can be a great benefit. Spouse, I get asked this all the time, like, should I have my spouse on payroll or not? If you're doing it only for
He's like this.
yes, if you're doing it only for Social Security benefits, I'd say, no, that's not a good reason to put them on payroll, because they're going to get spousal benefits whether they're on payroll or not. If they're actively working in your business, if you two are working together and they're part of the business, yeah, they're gonna be on payroll. But the times you do want to consider putting your spouse on payroll are for things like health insurance. You can set up what's called a health reimbursement arrangement and have the company reimburse for all medical expenses. And that can be a huge, if you've got a lot of medical expenses. It doesn't make sense if you're not paying a whole lot for medical. But have this conversation with your tax advisor. Does a health reimbursement arrangement make sense for me? Also, when you're self-employed, are some great retirement vehicles like a solo 401k. So you can put your spouse on payroll and allow both of you to max out your 401ks, which lets you to just put that much more aside every year. Okay, anybody here heard of Mark Kohler? You have, okay. He is huge proponent of small business, real estate investing, just helping this Main Street. He's called my certification. I did his whole program, and it's called Main Street Certified Tax Advisor Program. And so it's really there to help everyday small business owners. This is really small, but this is his trifecta. And I'd almost be curious to see how you have your whole entity structure set up, but basically you have, if you look at this, you kind of got the line down the middle, and at the very bottom, everything is owned by revocable living trust. This side of your line, you've got your operations. So this is going to be your real estate business. This is going to be any active income that you're building is going to be over here on this side. You do not want to hold real estate investments over here in your S corporation, because then you end up with what's called built-in gain. This is your holding side. So this is where your investment accounts, your Roth IRA, your rental properties, all of that is separate. And this is where you get an attorney involved as well. But this is kind of your overall, where he calls it the trifecta. It's your tax, your legal, and estate planning all put together in one. And I show you this because everything that I've been talking about to this point has been this side, you know, as far as being self-employed versus W-2 employee, and employing your family. That's all going to happen over here. But now I'm going to start shifting into some of the things like not even up here, the health savings account, your retirement accounts. So that's why I should put this up here to just kind of let you see. A health savings account is, in my opinion, one of the best tax vehicles, but it's not talked about enough. Here's the reasons. 3 advantages. So it's a tax deduction when you make the contribution. All of the growth that happens within the account is tax-free. And when you take the money out for qualified medical expenses, it's tax-free. So there are not very many things like that the IRS has put together that gives you all 3 of those to be tax-free. It's also nice because you can take it out before you are retirement age. So ideally, it's one of those things that you put the maximum contribution in every year and let it grow. Like, don't reimburse yourself for all of the medical expenses. We've been doing that. Sometimes I'm like, just pull it from the HSA. So sometimes it's a little balanceable. Yeah.
What is it's health savings account?
Okay. So, no, I'm glad you asked, and I'm happy to answer. So it's just, okay. First requirement is that you need to have a high deductible health plan. If you have a high deductible health plan, and there's that limit changes every year too. This year, I think it's 3,200 if you're single, 1,600, meaning like you have to pay that much on your health plan before the insurance kicks in. And it has to be health savings account eligible. So this is something you have to talk to your insurance guy about, or lady, your insurance agent, I should say. But it's worth looking at, because what a health savings account does is, like say, allows you to contribute money into this account. You can reimburse yourself for medical expenses, and it can be, there's a publication by the IRS that's like pages, and it lists all the things, and you'd be surprised what's on there, what you can actually reimburse yourself for. Or it can be a vehicle that's kind of like aiding your retirement, that you just let sit there and grow, because it, like I said, can grow tax-free. Did you know that your health savings account can even buy real estate? Okay, good, glad to know that. But no, you can, Invest.
know that, but I don't have.
Okay.
Well, look at the limits, though, you've only put in so much per year, so it's not like you're gonna have.
Yeah, but it rolls over.
For it.
But yeah, it's not a use it or lose it, so it can grow over time, and so it actually, you'd be surprised, especially when you're older. like
And
me.
yeah, I was gonna say, most people are gonna have more medical expenses as they get older.
So that's why it's a great retirement planning.
So it's something that's set up through medical, like basically like medical savings account.
You can, I
I
know,
don't have
like,
insurance, so.
oh, okay, you do have to have insurance and you have to have a high deductible health plan to be
Okay.
eligible
So
for
but
this.
it comes off your gross income, is that correct?
Yeah,
So if you make 100,000, put 10,000 into it, you're only making 90,000.
so the limits this year are
That's hard.
8,300,
Mm-hmm.
but you can put up to 8,300 and yeah.
For you, you're gonna put in, you say 4150.
Would that work the same with like, they have those, it's not really like you're getting health insurance, it's like one of those.
The healthcare ministry,
Yeah, something like that,
it does not actually work with that, unfortunately.
so it's only for those suckers getting insurance. I'm
Yeah.
saying.
No, that's a whole other conversation. I have a story on that.
All right.
And I know, believe me, we pay a lot every month for health insurance, but
I wanna hear that story.
Who pays most,
Yeah, off the record, we'll get to one here.
oh, ours is pretty ugly, but it's almost saved our tail a number of times too, so that's my story. I'll tell you, but something to keep in mind, because even though the limits are lower, like it can still grow. And like you said, as you're getting older, and that's one of the most expensive things when you're older is healthcare. You've got this bucket of money there that's you pull out tax free. So it is a good vehicle. I'm gonna just touch on this briefly, but being self-employed, you can maximize your retirement contributions. If you happen to be working, anybody here online that does to have a W-2 job, if your job offers you a match, I would say take that all day long because that's free money. So match whatever your employer's offering, but then look at setting up your own type of account. There's income limits on the traditional IRA, but there are workarounds with what's called a backdoor Roth. I'm not getting, this could be a whole other training topic just on
We'll have an
that.
advanced class later.
But just be aware that as you're self-employed, there are options. You can set up what's called a solo 401k. And contributions are like 23, they just changed. I think it's 23,000 for 2024. And you can also do an additional 25% of your salary. So that portion that you're paying yourself as salary, you as the employer can match. So you can contribute up to, I think it's $69,000 per, like each spouse could do that if you're married. So great way to ramp up your retirement. I'm hoping next year we're gonna meet those limits, right? We're gonna snap it out. No, okay, I want to talk a little bit about real estate and use here. I probably don't need to tell you the benefits of real estate ownership. I am aware of them. But obviously it's an asset that does appreciate. The value of it is going up over time. The nice thing about real estate investments is you can actually be getting a positive cash flow when it comes to your bank account, like you've got bank money coming in, but show a loss when it comes to taxes because of depreciation, because you can write off the mortgage interest, the insurance, the travel to go take care of your property. There's so many, Smiling, I know you know, but so many benefits to owning property that are good for tax purposes, and you've got somebody else paying your mortgage for you. So again, that's something that's gonna help you for the long run to grow your wealth. Bring in this trifecta again. Again, all of the real estate's going to be over here on this side. Okay, just wanted to show you this kind of diagram. Now, you running your real estate business is kind of on the worst side of taxes when it comes to real estate. If you set up your structure like we talked about with the S corporation and come up with all these deductions, it's still good. Like active income is just, any active income's gonna fall here. But it's still a good thing. But as you move along here, so ordinary rates are gonna be whatever your tax bracket you're in. Okay, sorry, I'm not explaining this very well. If you're here as a real estate professional, you're subject to self-employment tax. That's why it's here on the worst case. If you set up the S corporation, you can make part of it be here at your ordinary rates rather than just that extra self-employment tax. Capital gains, that's when you sell real estate. You're subject to maximum gain that you'll pay on that tax, and that is lower often than your ordinary tax rate. So that's why you go there. If you structure things with clients to sell it in an installment sale, you're gonna be spreading that gain over time, which allows you to spread out the taxes. You mentioned 1031. You know, as you get properties and want to roll them into the next one, this is a great thing that you need to be aware of with your clients, you know, ahead of time, again, and not after the fact, so that they know that they do have options. Or,
And for that, just. Having you here, so if I've got a client, like, hey, yeah, I wanna do a 1031, I know a bit about it. And I can go over, touch the bases, be like, hey, why don't you call the CPA, talk about it, have them call you, and you can say, hey, you know what, let's get you in the best position.
yeah, and I'm not like, there's 1031 specialists that will help you do the actual, like, hold the money and do all of that part, but I can talk from the tax side, yes. Hopefully you're all aware that there's an exemption on the sale of your own residence. It's up to 200, a gain of up to 250,000 if you're single and up to 500,000 if you're married. You do have to live in the home 2 out of 5 years, but you can do that every few years and not pay a gain or tax on that gain, yeah.
I just thought of this, what if I'm living in that house, I've lived in it for a few years, but after a year I got married. And so they haven't lived in it for 2 years, do they have to live in it 2 years?
I'm 99% sure that it's still good. I'm gonna double check on that, but I think it should still be married filing joint. If that's how you're filing your tax return, I can say I'm 99% sure.
I was just thinking that, it'd be worth it to make sure.
They'd have a big portion to marry me and then.
I recommend that.
He's gonna be like, someone's getting, let's keep the time frames.
Your spouse every 2 years?
Yeah.
You still would have the
That'd
250,000.
be auditable though? Everything's auditable.
Well, yeah, but you're saying whether you got married just for that exclusion, that to me seems like maybe it's not worth it.
Well, and you guys might know about this, but I guarantee over 90% of your clients don't know about it.
Yeah,
Yeah, and so that's why I bring up some of these things so that you can.
that's a good post.
There.
Definitely, definitely. Well, that and the 1031 exchange are great topics. If you've got investors you work with, just talking about that, because you can even do a reverse 1031 exchange. You can actually buy first and then sell your disposal property after, but you gotta set it up at the closing. So just having a little bit of information, like she said, talk to somebody like Linda for the tax advantages, but you've got an attorney or a facilitating company that's gonna administer that transaction. And you just gotta follow the rules. You gotta know what the rules are.
You gotta know the rules. There's certain days that it can only, you can't take receipt of the money, like there's rules.
Well, it has to
that
be in the same LLC, it's like, there's a lot of
There's
things
rules.
that, like, it has to be a certain way, or it's like.
Cause they try to con you out of that money. Like,
Yeah.
ooh, don't step
So-
out of line, cause we're gonna take it all.
Here's a quick example on that. I know this is
No,
one of this topic, but I had a client that knew about the reverse 1031 exchange, and he's a cash buyer, and he had bought a property. Literally like 2 or 3 weeks later, he wanted to sell one, and he said, hey, can I do a reverse 1031 exchange on that property that I bought? We didn't put it in the contract, and we had already closed on it, so that ship had sailed. It was done because it was part of that transaction. So if you've got an investor and they're thinking about doing a 1031 exchange, there's timeframes involved in or whatever. But by putting it in the contract does not obligate them to actually do it. But they can't do it if it's not in the contract. So think about that.
It's really good to know from the real estate side. So, and that's the word I was missing, is the facilitator. There are people, like I said, they will actually take receipt of the money, make sure that the dates and everything are all in line, but it's very much something to be aware of, because you can defer.
And you mentioned
defer.
You have that facilitator, Is that somebody you go through your title with?
No, it's a separate, it's an attorney, I've got
Oh, okay.
contacts, for sure, yeah, I can hook you up. So, and one other comment on since you asked about the primary residence thing, those 2 years don't have to be consecutive either, it's just 2 of the previous 5. So even if you move out of property and then you have to move back in, as long as 2 years doesn't have to be congruent, is within the 5-year period, then.
Yeah, so sometimes if you know you're gonna rent it, like, there's just,
Yeah.
again, tax strategies to know, okay, when should I live in it versus when should I rent it, and make sure your timing is
Think like
right.
an adult, long term, you know.
Yeah.
Better.
And then, a Roth IRA, actually, you can purchase real estate with your retirement accounts. There's definitely rules around that too, like you can't live in them, you can't personally benefit from the properties, but you can have renters in there, and you can have. I mean, I've been told Mitt Romney, like, that's where all his wealth came from, is from his Roth IRA and buying businesses with his Roth IRA, buying properties, like, there's a lot of cool stuff you can do that is tax free.
Buying congressmen with your.
Okay, so you as real estate professionals kind of have what I call coveted tax treatment when it comes to real estate properties. It gets complicated. There's passive income and non-passive income. So your real estate commission, that's non-passive income. If you are renting a property that is passive, you can only take passive losses to the extent of passive gains. Let me just go over this. Because I think some of this is on the other slides. There's 3 types of real estate investors. Again, let's be aware of with your clients. Passive means like, it's a deal, I'm trying to think of a good example, but basically you have no decision making on that. You're just putting money, like a syndication type of thing, depending on how it's structured. You don't have any control over that. You're putting your money in it. That's a passive investor. Anytime you are an active investor, that just means that you are making some decisions. Now, most of the people that I'm guessing you're working with, well, I shouldn't say that. Active investor, there's kind of this little, it's not a loophole, but if their income is less than 150,000, they can take a loss of up to 25,000 passive income against active income. If they're over that 150,000, then they don't lose it, but it kind of goes into this bucket that's suspended until they sell the property. So you always want to make sure that they're at least marking as an active investor. But you, as real estate professionals, like I say, this makes it so that you can deduct all of that passive loss against your real estate commission income. It's a huge benefit. So many taxpayers want this. And you've got it by being a real estate professional. If you meet these 2 tests, if you spend 750 hours a year doing real estate and your primary occupation is real estate and you materially participate, there's 7 different rules to say that you are materially participating. But it's much, much, much easier for you as real estate professionals to qualify and be able to take those losses and become deductible. Like I said, if you're not a professional, you don't lose them, but you don't get that immediate tax advantage. I think I'm going
So
to
it's-
more here.
Your real estate professional must get into your own product.
Mhm.
Well, then you just need to be working your business.
Yeah.
There's a lot of rules, like, again, I just went to an hour-long class just on that 750 hours. And how to meet them and what counts and what doesn't, but there's lots of rules, but this is.
I mean, that's what
a
tax advantages is to offset your income. So the other way she was talking about it, there's limits or there's rules that say you can't do it, but as real estate professionals, your losses from real estate, from your passive investing can offset your active income. So that's huge.
So cost segregation. Does everybody, do you know what that is? Yes, no, you may not. Okay. This is something again for you to be aware of for your client's sake and for you, but There's a lot of promoters online that are all about cost segregation and this bonus depreciation and writing everything off. They go tell everybody to go get a cost segregation, but they don't meet that real estate professional or this next part that I'm gonna talk about, and so they don't get the benefit. So it can be awesome if you qualify. So I'm gonna go over a few of the rules on it. Basically, like we talked about with the vehicles, it's depreciation that's writing off the value of the property over time. Cost segregation takes, I've got slides that I can show. I can explain it. I'm trying to explain it in a way that makes sense to you. It's going to allow you to create a loss when it comes to taxes because you're taking more depreciation at a faster rate, which then turns around and offsets your ordinary income. So it's creating that passive loss to offset your ordinary income. Typically, when you write off a rental property, if it's a residential property, you're writing it over 27.5 years. If it's a short-term rental or commercial property, you're writing it off over 39 years. What the cost segregation study is you basically have somebody come in and say, hey, this building has light fixtures, it has carpet, it has cabinets, things that could be removed from the property. And rather than writing off the entire building over that 27.5 years, it lets you say, hey, I've got these cabinets that are a 5-year property, so we can write that off faster. Now you've got that bonus depreciation, and that's why this was a really big hype 2 years ago, because when bonus depreciation is at 100%, that allows you to write off. I mean, people are taking 100, 200, $300,000 loss on a property in the current year to offset the ordinary income. That's when you hear some of these people that making a lot of money that don't show much income at all on their taxes. This is what they're doing. They're offsetting it with what's called a cost segregation study.
Question on that 27.5 years, is that resettable if you just hold the property forever?
No,
No,
it ends.
So to sell it to somebody,
if you sold it, then
they would be the benefits
they're
then.
gonna start depreciation, yes, but you would be done, like, then we've got to do your whole calculations, figure out what your gain or loss is on the property and sell it. It gets complicated, but this is why you have a tax advisor, right? And this is where I'm saying who should do a cost segregation study, and it's basically somebody who's going to be able to take advantage of that depreciation, and it's worth the cost. It'll take a long time, okay. But typically real estate professionals, this, you do benefit from this. Or the next one that we'll talk about, well, I'll be really quick here. Time up. Land is not depreciable. So basically when you buy something, you split it into land, the building itself, and then everything else, all the components that are inside the property. The cost segregation, like I say, is then gonna make it faster. All the stuff that would be able to depreciate over with that bonus depreciation. That was my extra slide. So I kind of talked about this, all the different components to it. You can have, some of them are gonna be 5 years, 7 years, 15 years for even like your trees. Cost segregation allows you to write off things that you otherwise wouldn't be able to that fast. This, I bring up the short-term rental loophole again, so you can have it in the back of your mind for your clients if they are not real estate professionals. Typically, so this is where I said there's kind of the 2 buckets. You've got passive income, you've got non-passive income. The goal is to make it so that your non-passive, your passive losses are offset by your non-passive income. Typically, sorry, not sure what that was, but yeah, it's stop recording. Okay, I'm being taken too long. I'm gonna skip. Here's the short of it. 5 ways to get around that limitation where I said that you can only, offset $3,000 of passive loss against passive income unless you sell a property, you've earned less than 150,000, and you have that 25,000 exclusion. You qualify as the real estate professional. If you have a self-rental, probably what you have here, you can use the same thing. And this is the one that I wanted you to be aware of for your clients. It's called the short-term rental loophole. That basically puts them into that status of being able to take the whole loss in the current year. There's really strict rules around it. They have to rent it for less than the 7-day average.
Sorry, whenever you touch it.
So they have to do both of this. They have to rent less than 7-day average and they have to materially participate in the activity. I bring this up just again, because it can be a big deal. I have a client that I just brought on this last month. She has a number of rental properties. She didn't think she qualified for this, and she made more than that 150,000, so she had all these losses that were getting suspended, and I said, hey, we can do this cost segregation, so we're gonna go back and fix that, and she's gonna get a huge refund because she's eligible for this cost segregation study. So I tell you that to just be aware. I don't expect you to know the rules, but know that it's there and just
An option for
option for your clients, yeah. So that was kind of it. I'm not ending, I got flustered with going over time here, I apologize, but, I know it's a lot of information. Again, I try to do a high level overview just so you can kind of have some ideas of what you should be talking to your tax advisor about, not to know all the ins and outs.
I think it's a
everything that there
great
is.
first presentation because there is so much. You can't go deep on any one of these things. But I think everybody's got a lot of ideas in their heads, even if you're not taking advantage of these things, as to just know about it and talk to your clients about it. So then you can hook them up with a professional so that they know that what their options are, because they may or may not find it out on their own. And if you save them tens of thousands of dollars or more because of rules to the game that they're playing that they didn't know about, you get credit for it.
Yeah. So I put together this little tax advisor checklist, just kind of questions that you should be asking tax advisor. Said, you're looking for one, we can talk, see if I'm a good fit to help you. If you have clients, you can let them know about me.
Is there information on this?
It is, and my website is very tiny there, but it'll take you to my website, Linda M. Tuttle. I have a lot of resources there. I've got some free things. I've got, yeah, a lot of
Awesome.
resources. So anyway, that's.
Hey, Jennifer, you got any questions on Zoom?
I have a lot.
Yeah.
No, I'm good. Thank you.
All right, thanks for sticking through to the end. Well, MJ just left, whoever MJ was. Ashley, okay, see you, Jennifer. We're gonna stick around here and have some lunch next time, come in person. Okay, see you.
Bye.
All right. That was great. Do you guys, have any more questions for her, or we can visit over lunch?